Hi there, it's Friday the 23rd of August 2019. I'm Steve Towers. Welcome to ITB. Let's get started. The US Trade Representative's Section 301 public hearing this week provided the predictable chorus of criticism of the French digital services tax. However, one interesting comment was made by several speakers, including Peter Hiltz from Amazon. He said that the compliance cost for the French DST, which requires the tracking of users' location data, will be millions of dollars. Meanwhile, President Macron this week publicly criticised the large US technology companies, which, in his words, enjoy a permanent tax haven status and do not contribute financially to the funding of the common good, which sounds like a rehearsal for this weekend's meeting between President Macron and President Trump at the G7 Leaders Summit in Biarritz. The US Court of Appeals for the Ninth Circuit has decided the Amazon transfer pricing case in regard to a cost-sharing arrangement. This was an appeal by the IRS against the 2017 decision of the US Tax Court. The Ninth Circuit's decision by 3-0 is to disallow the IRS's appeal. The taxpayers in the case are the ultimate parent company in the Amazon Group, Amazon.com Inc., and all of its US subsidiaries, which together form a US consolidated group. The US Tax Court referred to this group as Amazon US, and so will I. Prior to 2006, Amazon US had developed a European website business in respect of the UK, German, and French markets. As part of a restructuring of that business, Amazon US set up a new Luxembourg subsidiary, Luxco. Amazon US and Luxco then entered into a cost-sharing arrangement, a CSA, which had two main aspects. Firstly, it required Luxco to make a buy-in payment to compensate Amazon US for the value of the pre-existing intangible assets that were to be contributed to the CSA. And secondly, Luxco was required to make annual cost-sharing payments to compensate Amazon US for its share of the ongoing intangible development costs. The appeal to the Ninth Circuit concerns the application of the US cost-sharing regulations to the buy-in payment. And it's important to note that the relevant cost-sharing regulations in this case are the 1995 version. The Ninth Circuit says this in a footnote to the decision. This case is governed by regulations promulgated in 1994 and 1995. In 2009, more than 3 years after the tax years at issue here, the Department of Treasury issued temporary regulations broadening the scope of contributions for which compensation must be made as part of the buy-in payment. In 2017, Congress amended the definition of intangible property in Section 936H3B, which is incorporated by reference in Section 482. If this case were governed by the 2009 regulations or by the 2017 statutory amendment, there is no doubt the Commissioner's position would be correct. The key issue in the case concerned the definition of the word intangible in the regulations. The wider the definition, then the greater the number of pre-existing assets included in the CSA, and therefore the greater the amount of the buy-in payment. So, as you can imagine, Amazon argued for a narrower meaning, and the IRS argued for a wider meaning. The Ninth Circuit said this case requires us to interpret the meaning of an intangible in the applicable, but now outdated, transfer pricing regulations. The case turns on whether, as the Commissioner argues, the regulatory definition is wide enough to include all intangible assets of value, even the more nebulous ones that the Commissioner refers to as residual business assets. That is, Amazon's culture of innovation, the value of workforce in place, going concern value, goodwill, and growth options. The Ninth Circuit determined the meaning of intangible by following 4 steps. Firstly, the definition of intangible in the 1995 regulations. Secondly, the overall transfer pricing regulatory framework. Thirdly, the rulemaking history of the regulations. And finally, whether the IRS's position is entitled to so-called deference. I will look at each of these steps in turn. The first step is the definition of intangible in section 482-4B of the 1995 regulations, which is set out here. First of all, look at the start of the definition. To satisfy the definition of intangible, an asset needs to pass both of 2 tests. Firstly, it needs to comprise any of the items which are listed in paragraphs 1 through 6. And secondly, it needs to have substantial value independent of the services of any individual. Now look at paragraph 6. It says other similar items. If paragraph 6 stopped there, this could be a situation where the iusdem generis principle could be applied. In other words, the phrase other similar items would take its meaning from the common attributes in all of the items which are listed in paragraphs 1 through 5. In fact, Amazon argued just that. According to Amazon, the common attribute in all of the items listed in paragraphs 1 through 5 is that they can be sold independently. And therefore, Amazon argued that the phrase other similar items should apply only to assets which can be sold independently, and the IRS's so-called residual business assets are inseparable from the business. But as you can see, paragraph 6 doesn't stop at other similar items. It goes on to say, for purposes of section 482, an item is considered similar to those listed in paragraph B 1 through 5 of this section if it derives its value not from its physical attributes, but from its intellectual content or other intangible properties. According to the Ninth Circuit, that extra sentence in paragraph 6 allows the possibility that the phrase other similar items does not require an attribute of being separately transferable. The Ninth Circuit decided that the definition in the regulations does not provide a clear indication of whether or not the IRS's residual business assets are included in the meaning of intangible. Analysis of the regulatory text alone does not definitively resolve the question here. The definition of an intangible is susceptible to, but does not compel, an interpretation that embraces residual business assets. The problem is that residual business assets, such as growth options and a culture of innovation, are amorphous, and it's not self-evident whether such assets have substantial value independent of the services of any individual. It nonetheless remains that the definition of intangible could be construed as covering residual business assets if the language of Section 482-4B is viewed in isolation. But viewing the definition in the context of the overall transfer pricing framework does provide some indication against the IRS's residual business assets being included. The Ninth Circuit said this: if the cost-sharing regulations as a whole tip the scale either direction, they tend to favour Amazon on the issue presented here. The regulations describe a cost-sharing arrangement as an agreement to share the costs of development of one or more intangibles, and the regulations require the written agreement to describe the scope of the R&D to be undertaken. By identifying intangibles as being the product of R&D efforts, the regulations seem to contemplate a meaning of intangible that excludes items like goodwill and going concern value, which are generated by earning income, not by incurring deductions. The overall regulatory regime doesn't definitively resolve the issue, but it favours Amazon more than the Commissioner. In the third step, the Ninth Circuit considered the drafting history of the regulatory definition of intangible, starting with the Section 482 regulations adopted in 1968, and then progressing through the Tax Equity and Fiscal Responsibility Act of 1982, the Tax Reform Act of 1986, the IRS's White Paper in 1988, and temporary and proposed regulations in 1993 to the final 1995 regulations. The Ninth Circuit concluded the drafting history of Section 482-4B strongly supports Amazon's position that Treasury limited the definition of intangible to independently transferable assets. And so to the fourth step, which concerns whether the IRS's position is entitled to deference. The US Supreme Court decision in the recent Kaiser case held that deference to an agency's interpretation of its own regulations should occur only if the regulation is genuinely ambiguous. Having gone through the first three steps, the Ninth Circuit concluded that there is no genuine ambiguity in this case. Also, the Ninth Circuit found fault with the fact that the IRS for many years did not publicly announce its view that residual business assets were covered by the intangible definition. Amazon and other taxpayers were thus not given fair warning of the Commissioner's current interpretation of the regulatory definition of intangible. That interpretation is not entitled to deference. And so the Ninth Circuit concluded in this way. The Commissioner's calculation of Luxco's buy-in under the cost-sharing arrangement included residual business assets as part of Amazon's pre-existing intangibles. The language of the now superseded regulatory definition of an intangible is ambiguous and could be construed as including residual business assets. But the drafting history of the regulations and other indicators of Treasury's contemporaneous intent strongly favour Amazon's proffered meaning, that intangibles were limited to independently transferable assets. Treasury appears to have changed its position on the meaning of the regulation after Amazon and Luxco entered into their cost-sharing arrangement. We therefore agree with the tax court that the former regulatory definition of an intangible does not include residual business assets. For a copy of this case, please go to our website or app. In Australia, the full federal court has decided the appeal in Burton's case in regard to foreign tax credits. You might remember that I discussed the lower court decision in Burton's case in ITB last year. Let me give you a quick reminder of the facts. The taxpayer is an Australian resident individual who derived capital gains on the sale of investments in the US. As the investments were covered by the FIRPTA rules, the taxpayer paid US tax on the gains. The US tax was at a concessional rate, 15%, which was lower than the rate which applies to ordinary income. Australia also imposed tax on the gains. However, instead of using a lower rate, Australia provided a concession in the form of a 50% exclusion. 50% of the gain was excluded from taxable income. The taxpayer claimed a foreign tax credit for the full US tax he paid. The claim was made under both the Australia-US Treaty and the Australian domestic tax law. The lower court, however, agreed with the tax authorities that due to the 50% exclusion, the taxpayer was entitled to claim a credit for only 50% of the US tax he paid. Well, the full federal court, by a 2-to-1 majority, has now dismissed the taxpayer's appeal. In other words, he's entitled to a credit for only 50% of the US tax paid. For a copy of this case, please go to our website or app. In Hong Kong, the government has announced a series of tax and other measures to bolster the economy against adverse global events such as trade tensions and the risk of a global recession. And of course, the economic cost of the ongoing protests in Hong Kong. The measures are geared towards individuals and SMEs. In fact, I didn't find anything of particular interest to multinationals. For a copy of the government's announcement, please go to our website or app. In India, the report on the proposed direct tax code has been presented by the government task force to the finance minister, but it has not yet been publicly released. Those of you with long memories of Indian tax will know that this is the third attempt in 10 years to finalise and enact a direct tax code to replace the 1961 Income Tax Act. Well, maybe it will happen this time. A number of leaks from the report have emerged in the last few days. I'll go through those items of interest to multinationals. Firstly, it's been leaked that the report includes a full DTC bill, which is considerably shorter and simpler than the 1961 Act. Secondly, it's been leaked that the corporate income tax rate for both resident and non-resident companies will be reduced to 25%. As you know, there's currently a significant corporate income tax rate differential between resident and non-resident companies. However, it's also been leaked that a new branch profits tax will be introduced to apply to the amount of profits repatriated by an Indian branch of a non-resident company to its offshore head office. Now, that might sound like the taxation of resident and non-resident companies will not be aligned. However, I think the important point is that if the branch profits tax is levied only on profit repatriations, resident and non-resident companies will effectively be taxed in a similar way. 25% corporate income tax on the derivation of profits, and a corporate level tax on profit repatriation, dividend distribution tax for resident companies, and branch profits tax for non-resident companies. However, it has also been leaked that the corporate level dividend distribution tax will be replaced by a dividend withholding tax imposed on shareholders. Obviously, all of these leaks will need to be confirmed when the report is publicly released. Also in India, the Pune Income Tax Appellate Tribunal has decided a case in regard to whether payments made to a French company qualified as fees for technical services and therefore were subject to Indian withholding tax. The French company seconded one of its employees, Mr. X, to its Indian group company. Mr. X was appointed as the CEO of the Indian company, with managerial, administrative, and supervisory responsibilities. Mr. X's appointment was pursuant to an offer of appointment from the Indian company, which contained provisions in regard to salary and housing and other allowances. Mr. X qualified for the benefits under the Indian company's Provident Fund and superannuation scheme, and his leave entitlement was in accordance with the Indian company's rules. The tribunal accepted that Mr. X was an employee of the Indian company and was not providing services on behalf of the French company. Part of Mr. X's salary under the offer of appointment with the Indian company was paid into his French bank account by the French company. This is shown as number 1 in the diagram. Subsequently, the Indian company reimbursed that exact amount to the French company. This is shown as number 2 in the diagram. The balance of Mr. X's salary under the offer of appointment with the Indian company was paid by the Indian company to Mr. X in India. This is shown as number 3 in the diagram. From the two amounts paid by the Indian company, number 2 and number 3, the Indian company deducted tax at source on the basis that they were both salary of Mr. X and remitted the tax to the Indian tax authorities. The Indian tax authorities were not satisfied with that. They claimed that payment number 2 was a fee for technical services derived by the French company, and therefore Indian withholding tax was payable on the gross amount. The tribunal rejected that claim. It held that payment number 2 was not FTS derived by the French company. It was merely a reimbursement of payment number 1, which was part of Mr. X's salary, which was paid by the French company on behalf of the Indian company. An interesting aspect of this case is that the tribunal distinguished on the facts the 2014 decision of the Delhi High Court in the Centrica case. In the Centrica case, the payment to the non-resident company accrued to its benefit. According to the tribunal, that was not the situation in this case. For a copy of this case, please go to our website or app. In the Philippines, there's been some progress in regard to the proposed corporate tax reform. In Congress, the House Ways and Means Committee has now approved the bill for the Corporate Income Tax and Incentives Reform Act, known as CITIRA. The bill is now being considered by the full House of Representatives. CITIRA would reduce the corporate income tax rate, which is currently 30%, by 2 percentage points every 2 years until the rate becomes 20% in 2029. Just as importantly, it will impose significant limitations on corporate tax incentives, which have been criticised by President Duterte and senior members of his administration. For a copy of a statement issued by the Finance Secretary, please go to our website or app. In Vietnam, the tax authorities have issued guidance in regard to outbound payments for online advertising services provided by non-resident companies such as Facebook, Google and YouTube, which do not have a presence in Vietnam. According to the guidance, such payments will be subject to foreign contractor tax, which has two components, a corporate income tax component and a VAT component. The VAT component would generally qualify as input tax for the Vietnamese payer. The Vietnamese payer is required to withhold the foreign contractor tax from the outbound payments. The guidance does not address the issue of treaty exemption in regard to the corporate income tax component. For a copy of the guidance, please go to our website or app. In regard to EU state aid, the biggest case of all, the 13 billion euros case concerning APAs issued to Apple by Ireland, will soon start. A hearing before the European General Court has been scheduled for the 17th and 18th of September. In Germany, Federal Cabinet has now approved the draft bill to significantly reduce the solidarity surcharge, which I mentioned in last week's show. In Ireland, a business group, IBEC, has stated concern in regard to the impact on Ireland of major global tax developments. In particular, the Inclusive Frameworks Digitalisation Project, which it calls BEPS2, and the general reduction in corporate income tax rates versus Ireland's 12.5% rate. In its Q3 Economic Outlook report, it writes this: proposals under Pillar 1 will mean some reallocation of taxing rights to larger importing countries, and as a small exporting country, may mean that the Irish Exchequer will lose a proportion of its corporate tax base. Irish business, however, is more concerned about proposals under Pillar 2, which seek to introduce a minimum effective tax rate globally. It is crucial for small open economies that this rate, if introduced, is set at a level which focuses on addressing actual profit-shifting concerns and does not impact on our right to set competitive tax rates. These proposals are gaining significant momentum amongst the G20 and many of our traditional allies on tax issues. How can Ireland react? We must begin to prepare for a world after BEPS where non-tax elements of our business model will play a much more significant role in the location of investment. We are still in a period of global flux, but the trend is that average corporate tax rates across our competitors are quickly converging in a race to the middle. Tax is important, but alone is no longer enough. We must radically improve the non-tax elements of our regime, such as education, innovation, and infrastructure investment, if we are to continue to compete in the post-BEPS2 world. For a copy of the IBEC report, please go to our website or app. In Malta, the government has published the rules for the BEPS-compliant patent box regime, which was announced in last year's budget. For a copy of the rules, please go to our website or app. In Norway, the government has announced a 3-month public consultation on proposed amendments to the country's group contribution rules, which effectively enable the transfer of tax losses within a corporate group. The proposed amendments are designed to comply with the 2017 decision of the EFTA court in the Yara case, which determined that Norway's group contribution rules must allow a so-called final loss exception in regard to companies established in other EEA countries to avoid breaching the freedom of establishment rule. For a copy of the government statement, please go to our website or app. In Russia, a court has decided a beneficial ownership case concerning dividends under the Cyprus-Russia Treaty. Here's the relevant structure. An Estonian resident individual, Mr. Y, owned 100% of the shares of a Cyprus holding company. The Cyprus company owned 100% of the shares of a Russian operating company. Mr. Y also owned 100% of the shares in several Estonian companies. Dividends were paid by the Russian company to the Cyprus company. The Cyprus company used the cash from the dividends to repay existing loans from the Estonian companies and to make new loans to those companies. The Cyprus company was a pure holding company. Its only asset was the shareholding in the Russian company. It had no employees other than a director. Under the Cyprus-Russia Treaty, and having regard to the amount of capital invested in the Russian company, the Russian dividend withholding tax would be limited to 5%, provided the Cyprus company was the beneficial owner of the dividends, instead of the 15% rate under Russian domestic law. The Estonia-Russia Treaty, which was signed many years ago, has still not entered into force. The court held that, based on those facts, the Cyprus company was not the beneficial owner of the dividends under Article 10 of the treaty, and therefore the domestic law rate of 15% was applicable. An interesting aspect of this case is that the Russian tax authorities obtained information about the Cyprus company from the Estonian tax authorities, even though, as I said, the Estonia-Russia Treaty is not yet in force. Instead, the information was obtained under the Multilateral Mutual Administrative Assistance Convention, and it was obtained for tax years prior to the entry into effect of that convention in regard to both countries, an application of Article 28(6) of the convention. And speaking about Russia and beneficial ownership, the Russian tax authorities have issued guidance to tax officials not to assume that all holding companies and investment companies fail the beneficial ownership condition. Apparently, tax officials have been too quick to pull the trigger on this issue without a proper examination of the facts of each case. In the UK, the first-tier tribunal has decided a VAT case in regard to pre-incorporation legal expenses. VAT was incurred on the legal expenses by an unregistered individual who subsequently incorporated the company and charged the legal expenses, including the VAT amount, to the company. The tribunal held that, on the facts in the case, the company, which was registered for VAT, was entitled to input tax credits for the amount of VAT which it reimbursed to the individual. For a copy of this case, please go to our website or app. In the UAE, the tax authorities have issued VAT guidance in regard to the transfer of a business as a going concern. The guidance sets out the 3 conditions which must be satisfied for a transfer to qualify as a TOGC. There's a transfer of the whole or an independent part of a business. The transfer is to a taxable person, and the transferee intends to continue the business which was transferred. If the 3 conditions are satisfied, the transfer will not be regarded as a supply for VAT purposes. Importantly, the TOGC rules are compulsory. In Argentina, The government has announced emergency economic and tax measures in response to the sharp devaluation of the Argentine peso, which is expected to spike the inflation rate. All of the measures are focused on individuals, including, notably, a reduction of the VAT rate on 14 food products to 0. In the US, the IRS has changed its position in regard to the creditability of 2 French social taxes, which are imposed on income from employment and which are withheld by the employer. The IRS's new position is that the 2 French taxes are not covered by the totalisation agreement between France and the US and therefore are eligible for US foreign tax credit. For a copy of the IRS memorandum on this issue, please go to our website or app. Also in the US, Treasury and the IRS have issued Notice 2019-46 in regard to transitional rules for domestic partnerships and S-corporations concerning GILTI. For a copy of the notice, please go to our website or app. And also in regard to GILTI, the New Jersey state tax authorities have replaced controversial guidance on the allocation methodology for the inclusion of GILTI and FDII for state corporation business tax purposes. The new guidance is in Technical Bulletin TB-92. You can find a copy of that bulletin on our website and app. And now for this week's treaty developments. And I think almost all of the world's treaty negotiators are on vacation. All we've had is one protocol signed, and that's only in regard to the Exchange of Information article. I have 2 articles for you this week. The first article is called International Tax Rules for the Digital Era. It's written by Francois Chadwick and it's published in Tax Notes Today International. In this article, the author provides a proposed solution in regard to Pillar 1 of the Inclusive Frameworks Digitalisation Project. He also provides a numerical example to illustrate the solution. The proposed solution is based on a modified residual profit split, which is one of the alternatives described in the Inclusive Frameworks Program of Work. It consists of 5 main steps and several sub-steps, as set out here. Please hit the pause button if you'd like to study this. The author's comments in regard to another of the alternatives in the Program of Work are interesting. We also considered a distribution-based approach like the one outlined in the work program. That kind of approach would be intended to ensure that market jurisdictions collected a specified formula-based baseline profit for distribution-related activity, resulting in a reallocation of both routine and non-routine profits from other jurisdictions. However, we believe that kind of approach is not well suited to addressing the full range of the tax challenges identified above. In particular, it does not appear to be an effective way to address the situation in which advertising is targeted at non-paying users in a jurisdiction, while paying customers are outside that jurisdiction. It also appeared more challenging to design a proposal like that in a way that focused on clear principles for allocating revenue between market and residence countries, rather than an arbitrary, politically driven line-drawing exercise. Thus, we were concerned about both the longevity of that kind of solution and the potential for inconsistent administration to give rise to disputes. The second article is called Cognitive Biases in Functional Analysis Interviews, Part 3, Biases Affecting Post-Interview Processing of Information and Concluding Remarks. It's written by Aditya Panze and it's published in IBFD's International Transfer Pricing Journal. And you might remember that I covered parts 1 and 2 of this article in ITB on the 15th of March and the 7th of June, respectively. The author provides many examples of how bias can creep into the post-interview processing of information. In other words, the writing up of the notes of the interview. Let me share 2 of them with you. Here's the first. It is a common enough occurrence that the functional analysis interview notes are different from participants' recollections of the interview. It is particularly embarrassing when the person interviewed is appalled at the inaccuracies in the functional analysis interview notes. This occurs because of a cognitive bias called leveling and sharpening. At their very core, functional analysis interview notes are a retelling of a story that the participants heard during the interview. There is a likelihood that the person preparing the functional analysis interview notes has made additive or subtractive edits in the story during retelling, mainly to fill in the gaps in their memory or knowledge. Reducing the time between the interview and the finalising of the functional analysis interview notes, including review by the interviewee, will likely be effective in countering this cognitive bias. And I would add, an audio recording of the interview might be a good idea. And the second example is this. The outcome of the functional analysis interview is entity characterization. After the functional analysis, the transfer pricing expert should ideally be in a position to say whether the distributor is a limited risk distributor, a fully fledged entrepreneurial distributor, or somewhere in between those 2 extremes. Therefore, one key function of functional analysis interviews is to bring out the nuances of the functions performed, assets employed, and risks managed and assumed. However, there is a possibility that the differences will be over-examined and overvalued. This is called the distinction bias, which one blogger has very aptly termed reflexive nitpicking. The issue, as always, is missing the forest for the trees. That is, being wrapped up in details that otherwise would not have been considered important. Well, that's the way it is this Friday, the 23rd of August, 2019. I'm Steve Towers. Have a great weekend.